Hey, Paul, what stocks are you interested in? Now, the first thing I say is, guys, I'm interested in any great investment I can make. My joke is, if I can buy a bag of dog poop for $1 and sell it for $2 tomorrow, I'll buy it. Now, in the world of stock investing, it's a little bit different. But what I do is I pick companies that I love, companies that I can understand. Nike, Google, Microsoft, Apple, all these companies that I can really understand. And I don't just buy them, though, because I love them. That is the first mistake investors make. I love this company, therefore I buy the stock. Do not do that. You will probably not do very well in the long run. Why? Because other people think like you. And when other people are doing the same thing, the stock is getting higher and higher and higher, which you think, well, isn't that what we want? But remember, over a long period of time, stocks are based on what is fundamentally behind them. In the short run, they're based on the votes, the voting machine behind them. So as everybody votes them up, the stock goes up. But that stock going up is not affecting the fundamentals of the business, okay? So what we have in our software here is we have a watch list. I'm going to click on my watch list and show you guys what I have. I have 87 items on my watch list. These are all companies that I, in some way, shape, or form, probably understand and find interesting. So what do I do with them? Well, I use our software and our 8-pillar process to screen them out. And then I use our analyst estimates. So let's pull one up, for example, Adobe. First one on the list, alphabetically. I look at the 8 pillars. Boom. Love this. Why? Because these 2 X's are all valuation metrics. They're a reflection of the price of the company on these 2 levels. So all I need to do is wait for the price to fall. But it doesn't necessarily mean the company is overpriced. The company could be a fast-growing company in which they can justify a much higher multiple of earnings and free cash flow. I'm okay with that. So what do? I go to the analyst estimates first. What are analysts saying? Now keep in mind, I don't trust analysts when it comes to buy, sell, short, hold, whatever. Because it's very interesting to me that if you look at a company that's followed by 100 analysts, very, very few, maybe a handful, less than 5, will give it a sell rating, even though it might be a sell. Why? Because they're still influenced on Wall Street. These analysts work at firms that want to get fees from these companies. However, when it comes to the revenue and earnings per share estimates, they are very intimately involved with these companies, so I'm going to put a little more credence in those numbers. I still sit there and use the analyst estimates as my high expectations for the company, but it's a great guiding point for me going forward in our stock analyzer tool. This is where I use our stock analyzer tool to make assumptions about the future, to then pick a price for the company that I use to add to the watch list. So as an example for Adobe, I'm at analyst estimates, and profits expected to grow mid double digits per year for the next 5 years. And look at revenue, low double digits. That's pretty impressive. Now, I use that going forward in our stock analyzer tool. Now, those estimates are for 5 years. This is for 10 years. My first order of business is to be more conservative. As the company gets larger and larger and larger, my guess is the revenue growth will decrease. So even though the 5-year estimates of revenue growth are low double digits, for 10 years, I want to take that a little bit down. So I might sit there and go 10% on the high side, and I might go 7% in the middle, 4% in the low. Now you might sit there and say, Paul, that's so low, 4%? Yeah. My goal, we don't know what's going to happen in the next 4 years. If all of a sudden there's a recession, things like that. Remember, the emotional parts of the market will drive stocks to crazy levels. I want to see how crazy those levels are by making crazy low assumptions. That way, when I see them going, man, they're selling for cheaper than my lowest assumptions that they're already crushing. That's the goal here for investing. Next thing, profit margin. Now with profit margin, I see a little bit more consistency here. And in the future, there'll be more consistency. So I might go 23, 25, and 27% here. Now for free cash flow margin, much higher than profit margin. So I'm going to go higher than that. I'm going to go 35, 37, and 39. I'm still going to keep it lower than they've done because during economic booms, free cash flow margin and profit margin will be bigger, and during recessions, they will contract a little bit. So I still want to be more conservative than the numbers up here. Now, finally, PE and price to free cash flow are our next 2. This is where everybody gets all hung up on. Why is that? Well, the current PE is 28, and everybody's first inclination is, well, if it's 28 now, something conservative is 25. No. I look at it and say, what's the reason why this company should sell for above or below the historical average of 15 or 16 PE on the stock market? What's the reason? I don't know. If there's a lot of growth potential and this company has good growth potential, maybe I want to pay a premium. So I'm going to go on the low side, 13, 15 in the middle, 17 in the high. And same thing with free cash flow. Because if they do 4% growth, that's not a lot. I should get some sort of discount for the company. Because that's basically growing with GDP and about the size of the country. So it's kind of like I shouldn't pay a premium for that. Now, the final thing I put in here is my desired annual return. Guys, you can get 9 or 10% by investing in a long-term ETF, right? So in order to buy an individual company and have a proper margin of safety, and margin of safety is so important for everything you do in life, especially for investing. But you put that seatbelt on your car every single day, that's a margin of safety. Why? Because how many car accidents are you really going to get in your life? And secondly, those car accidents, how many of them are really going to be bad? But we still do that. Why? Because it's so easy to do. It greatly increases our chance of surviving any car crash. Same thing here. Put your margin of safety in here. And the higher my assumptions go, the larger margin of safety I want. So I'll start here with 12%, 14, and 16% return over the next 10 years. And very simply, I hit the analyze button. Now, as you see here, the stock is currently on watch list at $200. But I want you to remember, before I show you the prices, I don't necessarily mean when I put something on a watch list at 200 that I want to buy it at 200. It might be an indication for me to start doing more research because it's getting close to my price, and I can also sell puts at lower prices to generate income. So this might be the point of me saying, Paul, you're getting close to your price. Start selling puts at a much lower price to start generating some income while you wait for the stock to fall the price you want. And this is one of the things that have really changed the people in our community's lives. Learning to use options to generate income while they wait for stocks to fall the prices they want. Okay, so hit the analyze button, boom. Okay, low side, 110 to 160. You might be like, boy, why is this so different? Well, this one's based on cash flow. This one's based on earnings. And if you remember above, the free cash flow percentage was much higher than the earnings. Middle side, 140 to 200. High side, 170 to 250. So I like that $200 number as a starting point for me to go, listen, start paying attention because this is where you want to be. You want to own a company like Adobe. They dominate the Photoshop market, the editing. I love it. They're going to subscription-based model that's going to generate more margin. I love the model there. So I have these numbers. Let's say I want to change my number to the watch list at 205. I just sit here and add it to 205. I'm going to delete this. Notify me. Now, I'm going to go to my watch list. And like I said, guys, it's now at 205 on my watch list and all these companies here. With our software, it's going to email me every single time the company does what I want it to do. When it goes below 205, I'm going to get an email. I'm going to get a notification on my app. And I'm also going to get a notification on the software telling me, hey, Adobe has gone below 205. This is your point to start doing whatever you want to do with it. That's the important part of the software. I can sit back, relax, and wait for the stock to fall. And guess what? I have 87 stocks here. As I go through more and more companies, it's going to happen more and more often. It lets me sit there and wait and be patient because I know things are working in the background for me. So this video, if you're new to the channel, is a very important aspect of how we look at stocks. I guarantee you that if you watch 4 or 5 more of our videos, you'll walk away having a better understanding of money and investing. And even if you don't agree with everything I say, you'll still walk away saying, hey, this guy's process is pretty good. I don't agree with everything because guess what? I don't agree with everything Warren Buffett says. I don't agree with everything Howard Marks says. And even my good friend Gary Mashuris, I don't agree with everything he says. But we have our own way of looking at things. So you need to watch the next video in which Mo and I go through our process for how we find stocks that we like and how we go through the process of using our 8 pillars to identify analyst estimates and stock analyzer tool to determine the price to buy for the company. As the market falls, one of the most common questions I get is what stocks should I be buying as the market falls? Great question. We're going to get into it right now by looking at our process for how we buy stocks.